Good afternoon and welcome to our webinar, Business for Sale, an introduction to the process of a successful business sale or acquisition. Our discussion today will be led by Wendy Roberts. Wendy prides herself on creating winning strategies while helping her customers maximize their resources and their profits. As a CPA, she knows her way around corporate financials. As an entrepreneur, startup CFO, and CVO for NorthStar Strategic Partners, and a former corporate executive, Wendy offers a broad insight into finding solutions to help her customers achieve exceptional growth and financial success. She has a bachelor's degree in accounting from Indiana University, MBA courses at the University of Tampa, and years of experience counseling customers on financial and profitable success. Wendy is originally from the Midwest and was raised in a working class family. One of her most favorite and cherished hobbies is cycling. She never fails to miss a weekend cycling in the Bay Area and taking in the panoramic views. At the end of the webinar today, we will be sending a copy of Famous or Rich ebook by John Warlow to the registered email addresses. So enjoy and let's hear it from Wendy.
Thank you, Shai. Thank you so much for that introduction. And thank you, everyone, for being on our webinar today. We're very excited to have you here. And I am excited to talk to you about selling and buying of a business. So on our next slide, we're going to be looking at what I call the wheel of fortune for those sellers. Usually it starts out with selling from the seller's standpoint. What are the seller's goals? Some of those goals may be that you are ready to retire and move on to your next step in your journey of life. Another one might be that you have family members that might want to purchase your business from you, or maybe you want to pass it on as part of your legacy. A third might be a strategic play in which you want to be able to sell to a much larger company in order to be able to have a buyout in that situation. Or you might just be saying, I want to start my next venture. I've done everything that I need to do with this company. I'm anxious to move on to something different. All of those are very relevant goals. There's no reason why one or the other is preferred. It just really depends on you as that seller. Now, I want to talk a little bit about each of these steps. You'll notice on the outer ring, there's 5. Okay, so each one of those outer ring incorporates steps within each of these. So when you look at the decision to sell, again, going back to, is it a strategic buy? Is it a family situation, whatever the case may be, that's an important level of what to do with that. Okay, the next level is the pre-market. Then after that is the going to market. Then we do the due diligence, which I'll get into in a little bit. And then finally, we have the close of the deal or the transaction. So let's talk a little bit about each of these pieces. The first one in the decision to sell is the valuation. That is the sales price. This is very, very important. It is the starting point. When you look at a valuation, you're looking at your financials for your tax returns, also some projections. We run that through a tool such as peer comps or other tools in order to determine what the multiple would be, and then compare that to other companies in your industry code to see what the range of the price could be that you could garner for your company. The next is preparation of due diligence and your tax planning. I recommend that you do this early. Once you have decided that you want to sell your business, doing your due diligence and doing the tax planning is so very important. Do not wait until you have a contract and then you got to say, okay, how am I going to handle the taxes? It really could be too late at that point. Or even worse is that you sold your business and then you got to deal with the taxes. That's not a good strategy at all. So when we take a look at the due diligence, make sure that you have accurate, up-to-date financials, that everything is in place, because that buyer is going to be asking you for that information. The next one is what we call the confidential information memorandum, our CIM. This is usually prepared by an M&A advisor, such as myself, in which we go through and we collect lots of data about your company. It can be the financials, it's going to be the valuation, it's going to be information about your employees, your industry, whether or not you own the building or whether or not you lease. All kinds of information will be in here in order to prepare for a buyer to look at your company and do its due diligence. Now, once we have the CIM, then we go into the pre-market, which is the buyer research. Who is your ideal buyer? Who is that person or that company? So we would be working with you to figure out what is the best buyer for your company. Then we start doing that research. Then the next one, which I think is so, so very important, is your team. It takes a team to sell a company. Now, what I mean by team is your CPA, your attorney, your financial planner, because you want to know what am I going to do with the funds once I sell my company, your insurance agent, and of course, your M&A business advisor. So all of these people are going to be working with you to ensure that the transaction is very smooth, all of the I's are dotted, the T's are crossed, and it makes it much more greater journey for you by having a team around you. Then we go to market, what we call going to market. That's where once we've identified the buyers, we then contact them to see if there is interest in looking into buying your company. Once we have some interest from potential buyers, then we go through what we call an NDA, which is a non-disclosure agreement. That non-disclosure then would show to you as the seller that the buyer is going to hold information that you share with them in confidential reasons and confidential purposes. Then once we get the NDAs and they've gone through some of the documentation that we provided to them, then there would be potentially an indication of interest. This may or may not happen. The larger deals usually have larger buying pricing, so you're going to probably have a larger pool of buyers. Those will have an indication of interest, and then once we go through that indication of interest, then we go to what we call an LOI, which is a letter of intent. Now, in some of the smaller deals, we might skip these two steps and we might go directly to an APA, which is called an asset purchase agreement. It really kind of just depends on the size of the deal, whether or not it's mid-market or if it's a main street sale. Once we go through this with the LOI, then we go through due diligence. And this is where I alluded to before. As you as a seller need to start prepping for this, because due diligence can last several weeks potentially, or it could last several months depending on the size of the deal and who all the players are. In some cases, the buyer is going to have their own team of CPAs and attorneys and others that'll be part of the transaction. And then of course, you as the seller are going to have your team. Those two teams on both sides, because one represents the seller, the other represents the buyer, is going to be exchanging information back and forth between the two to make sure that the numbers that you say your company is producing as far as revenue and expense is actually true. So it's a very elaborate process. It does take a professional to do that, and we'll get into that a little bit later. Once we've done the due diligence, then we go to the financing piece and the legal piece. This is where we work with bankers and others. It could be private equity firms, it could be venture capitalists, whatever the case may be. We go through the financing part, which is very important for the buyer. Some cases it might be a cash deal. Those tend to be, I think, in my opinion, more rare, but they could be. It could be a stock sale, which we'll get into, or it could be an asset purchase agreement. And then once we have gone through the financial and the legal and go through the actual contracts, then we go to the final steps, which is the close. And sometimes we go through escrow, more times than not. And then we go through the closing of the transaction and then the passing of the legal entity or the assets over to the new buyer. So as you can see, it is a very big process. It's what I call a 12-step process that we go through. Now I'd like to go into a little bit more depth, a little bit more on some of these aspects that I think are important for those of you on the call here. And the first, as I alluded to, is the pre-market process and that valuation report. That is, as I mentioned, it is the starting point. It is the factor that will help determine what the sales price is for your business. The next, as I mentioned, is the audit preparation. That's so very important. Doing that due diligence, getting ready for that, because it's going to be a lot of back and forth. For a lot of sellers, they may not understand that, especially if it's more of a Main Street deal, which Main Street is more of, your mom and pop, if you will, versus the larger, more advanced companies like the mid-sized firms and companies. Next, as I mentioned, was the tax strategy. It's very important for you to have this in place. You need to know where you're going to go, and don't wait till last minute to be able to prepare for that. Next is going to market. And as I mentioned before, that there's an outreach that we do with the buyers, plus there's the NDAs, which is the confidentiality agreements. Those are very, very important. And then, as I mentioned, we have the indication of interest, our IOIs. Then finally, we go into our marketing, that we're going to have a selection of those buyers. And who do we think are going to be the top players that could be purchasing your company? Then we go through what I mentioned before, that LOI, the letter of intent. And then finally, the buyer and the seller agree upon the signed LOI, and that's when we start the next process of that due diligence. So once we have that signed LOI, or that APA, that asset purchase agreement, then we go through due diligence and legal. All right. So that due diligence, as I mentioned before, it can be very extensive. And you as a buyer and you as the seller want to make sure that that process goes through. For the buyer wants to make sure that what they're paying for is what they're actually going to be getting, right? And for you as the seller, you want to make sure that you are open, transparent, and that your numbers are accurate. Then on our next slide, I want to talk to you a little bit about two types of business acquisitions. The first one is the asset purchase agreement, or what I mentioned here before, of APA. It usually is the purchase of assets of the entity, and that would include inventory, fixed assets, intellectual property, anything that would be a value that would be considered an asset. Excuse me. It normally does not include cash or accounts receivable. It also does not include the liabilities of the entity, the seller's entity. Then the second type of transaction is the stock purchase agreement. It's where you are actually purchasing the stock of the entity. This could be a C corporation, it can be an S corporation. And in this case, this is where it's probably more advantageous to the seller, because they get a capital gains treatment for that stock sale. One thing to know for the buyer is that the buyer assumes all the liabilities of the entity. It's very important to know the difference between the two. And as I mentioned before, tax planning is very important for you to consider, both from the buyer standpoint and as well as the sellers. Now let's talk about what makes deals fail. Now I've listed several of them here. I'm going to touch on a couple. And I think one of them is an unreasonable or unsubstantiated valuation. Again, doing a valuation needs to go through a process of getting data from the seller, getting the financial statements, getting the tax returns, and comparing those to comparable sales of your industry. That's so very important. If you have an unsubstantiated valuation, you're probably not going to sell your business. It's Just it's flat out. It's market driven. The next is lack of preparation of financials. Unfortunately, of some mainstream companies, they do their own books, or they have situations where they might not have the most accurate books. Having inaccurate documentation is more than likely going to really cause a sale to go awry. The next one is having unresolved financial or legal issues that have not been disclosed. I cannot stress this enough. You as the seller, you need to be transparent, forthright, honest, even if it does not look good for you. To be honest and forthright and transparent tells the buyer that I can trust you. It's so very important. And then last but not least is undocumented business operations or processes. This is what we call standard operating procedures. The buyer wants to know that this business can run without you. And with standard operating procedures, it's a rinse and repeat process. Not having them documented could definitely affect the sales price or even drive down the sales price. So it's worth it to you, in addition to getting your financial statements in order, getting your processes documented before you put the company out on the market. As you've heard me talk about in other webinars that I have done, there are 8 critical factors that a buyer looks at when they want to purchase a company. One of those is whether or not there's documented standard operating procedures. A second one is the financial performance and whether or not your financial statements, your balance sheet, your income statement or profit and loss, your statement of cash flows is accurate. Because what you got to remember is a buyer is buying your company for future cash flow. They want to know, can I get my return on my investment? If they don't believe they can get the return on their investment, you're not going to have a sale. Now let's talk about what makes deals succeed, right? Again, I've been talking about this throughout this webinar. Getting the company ready to be reviewed both internally and externally. That's making that massive undertaking to get ready for an actual sale. It usually takes 9 to 12 months to sell a business on average. During that time period, you can get yourself set up for that ultimate sale. Second is a complete transactional documents and the tax planning that needs to go around that. And then, again, I'm mentioning the CIM, which is that confidential information memorandum. That's so very, very important to get that done and drafted so that it's ready for that buyer so they can take a look at it after they've signed the NDA and the other steps that need to be taken. All right, once we get through this process, then we go to close. Well, all conditions are satisfied. In other words, we usually go through what we call escrow, and it's very similar to going through escrow of a home. Is you have the buyer and then you have the seller, and there's certain instructions that are set aside by the escrow company that each buyer and the seller have to do. There's documents that need to be signed. Once all of that happens, then we actually have a successful close, right? The funds are deposited, the purchase agreements are all signed, and then you can relax as a seller because you have now transferred your business over to that buyer. Now, what can we do at NorthStar? You have a listing here. First and foremost, we do business coaching as well as advising using our 4 points of focus. And I would love to be able to talk to you guys a little bit more about that if you would like to find out what the 4 points of focus mean. It's very definitive. Also, if you are looking for on-demand or fractional CFO services, we offer that as well as the other things here that you see. We are a big promoter of the Profit First methodology, as well as the Value Builder methodology, which helps you set your company up for success. As I mentioned, those 8 critical factors that you as a seller need to consider, because those 8 critical factors are what buyers look at. And that information is based with over 60,000 businesses that have been sold in North America. So we can help you get ready for an ultimate sale, whether that is a 12-month period, 24-month period, maybe 3 years out. It's never too early to start planning an exit of your business. And so on the next slide, this is how you can contact us. You can reach out to me at wendy@northstar-sp.com, or you can reach out to me on my phone or LinkedIn or these other venues. So I think we'll open it up to question and answer, Shai. We have time for a few questions.
Yes, Wendy, we have a couple of questions.
Okay.
So the first one is on the process wheel that you presented earlier, do I have to go through all of those steps even if I own a small sized company?
The answer is yes. It's highly recommended that you go through all of those. Now, you may not get an IOI or an LOI. You might go directly to, like I mentioned, an asset purchase agreement right from your NDA and some of your due diligence. Then you go to the asset purchase agreement. So you might, depending on the size of the deal or the transaction, you might skip those two. But I do recommend, obviously, you have to have evaluation. I do recommend that you go through and prepare for the due diligence process. You definitely have to have a CIM no matter what, as well as building that team. Having that team that is so very, very important. What I advise sellers, don't try to cut corners. This is a very big transaction. It's probably your second biggest, if not your biggest transaction. Probably your second biggest transaction might be the purchase of a home. Is very important because this money is going to probably go into your retirement fund. Again, you want to have that financial planner with you, that banker, the attorney, your CPA, and of course your M&A advisor. All of these people help lay the foundation so you have a successful transfer.
Perfect. Thank you. We have another question. How would I know my business worth?
Yes, how would I know if your business is worth? Well, again, that is from the valuation. So the valuation, if we go back to that wheel, the valuation is the very starting point. And we would be basing it on the tax returns that you filed with the federal government, any projections that you have, that we would be doing projections, your current year financial statements, year to date, then we would then extrapolate that out for the annual, as well as knowing your industry code. And we would put some weight to that on different type of methods, right? There's 3 different methods. There's the asset method. There is the income or revenue method, which is discounted cash flows. And there's also the comparative method of companies that have been sold that are similar to your company and your industry code. We then take all of that together and then we come out with a range of a sales price, and then you decide on the sales price based on that data.
Perfect. Thank you. We have a follow-up question. Do you conduct valuations for the companies or use third-party valuation for experts?
So what we do is we're called it's a broker of opinion. I actually have a real estate license. So in order to sell a business here in the state of California, you have to have a real estate license. So I have a real estate license and we prepare the valuation as part of the CIM.
Thank you for that information. Another one, how do you integrate with an M&A advisor?
How do I integrate with an M&A advisor?
Uh-huh.
Oh, okay, cool. So I guess you could kind of consider me an M&A advisor through the M&A brokerage. I usually work with sellers prior to the time they want to sell. So if they want to sell 12 months, 24 months, out into the future, I will work with them to make sure they increase the valuation of their business as much as possible. We'll put in different scenarios based on those 8 critical factors that I mentioned. We will look at different scenarios. If we increase your financial performance by X amount of percentage, how much does that increase your value of your business? So we would go through that process, get your company ready for as much of the valuation as possible. Then we would work with the M&A company to sell the company. And again, that's where my real estate license comes into play.
Awesome. Um, and another question, Wendy. Do you supplement or replace legal counsel in company sales?
Oh no. Great question. Oh no. You probably heard me say that one very fast. No, I do not represent legal counsel, nor am I practicing law. So no, we would definitely have an attorney involved in this process.
Thanks for that information. And I think we have more time, a couple of minutes for one last question. Have you helped other clients with the sale of their business? How did it go? Or
Ah, great question. Well, we like to think they all go successfully, right? But you know, there are sometimes you get through the process, you get through the due diligence, you have a contract, and then something, as I mentioned before, something isn't disclosed. And if it's not disclosed through transparency, like we talked about with the seller, the buyer gets uneasy and the deal or the transaction does not go through, it fails. So, you know, it's very back to the comments about what makes a successful sale versus what makes an unsuccessful sale. I cannot stress it enough. Good financial records, transparency, honesty, etc. That will go the furthest in making a very successful sale. So I like those that are very transparent. I'm working with a buyer right now that I'm representing. They have an agent who's the seller on the other side. And the seller has been wonderful. They have been very transparent. And it's been a great experience for that buyer. And so the more cooperation you can have from the seller, the more it's going to get comfort to the buyer that they are actually purchasing the information, the company, the financial resources of that company is intact, and that they're going to get their return on their investment.
thank you for sharing your experience, Wendy. And those are the questions that we have for today. And to all of the attendees, here is how you can reach Wendy. And we will be reaching out to you after the webinar.
Thank you, Shai, and thank you everyone who's been on this call today. I really appreciate you. I see some familiar names on the screen. Thank you for attending. Also, I hope you have a very safe and happy 4th of July weekend. And to all of you, again, thank you, and hope you have a very blessed day. Thank you very much.